Nvidia shares are flying high. Is there still money for investors to make? Well, to find out, I'm talking with Eric Beiley of Steward Partners. Eric, welcome.
Andy, thanks for having me.
You're a big fan of Nvidia, but the stock is $800 a share. Should investors be getting in now?
Well, I'd first like to disclose that I personally own Nvidia. I've owned it for a while. But to answer your question, yes, I still think Nvidia is attractive at these levels. The growth from the company is justifying this price. If you look at their earnings, if you look at their revenue growth and their earnings growth and the demand for these AI chips, they're clearly way ahead of everyone else. And so investors are very confident buying Nvidia, and you're seeing the analyst community who cover Nvidia raising their price targets. And so while it's trading at $800 and worth $2 trillion, yeah, I would continue to hold, and I'd probably acquire it if we saw dips, right? At these levels, it's certainly high, but any dips, I would take a position.
So are there other tech stocks that you're seeing out there where investors could maybe, start gobbling up shares?
Tech has clearly fueled this market. If you look at the growth in general since last year, right, 2023 now into this year, growth has fueled this incredible surge in the market. We've seen with the NASDAQ hitting all-time highs. And semiconductors clearly have been very strong. The Mag 7 have been very strong. So Amazon just entered the Dow. So yeah, tech is a core part of anyone's portfolio. You clearly, if you're going to be invested in the market, you need exposure to the tech sector.
And so last time you were here, you thought that maybe in 2024 we would see a recession. Do you still feel the same about that?
Today, I would say no, even though the indicators are still there, which is the inversion in rates, right? The long end of the interest rate curve, longer-term bonds are still lower than short-term bonds, where money markets, 1-2 year treasuries. And that's always been historically has always been an indication of a recession coming, that the economy is going to slow down. Investors are telling us long-term rates are lower because they anticipate slower economic environment. This has been very unusual. Rates are north of 5% from Fed policy to push inflation down. But the economy has stayed very strong, right? Employment is still very low. Companies are doing a very good job. We're seeing huge demand out of this AI boom in tech and that space. And so right now, there's no indicators that a recession is coming.
You were suggesting your clients get involved with Dividend Aristocrats. Are you still doing Dividend Aristocrat investing?
Oh, yeah, 100%. I mean, dividend investing historically and over time has been a great place to be for long term, because these are companies that are sharing their profits with their shareholders. And so these are companies that are committed to paying out of their profits back to their shareholders year after year. And the aristocrats, the unusual thing about the Dividend Aristocrats, are these are companies that for 25 years, every year have raised their dividend. So regardless of the economic environment, whether we're in a recession, good times, bad times, they've continued to raise that payment. And so these companies have shown over time they're very disciplined in how they run their business. They're very fiscally strong. And so absolutely, I've always liked those companies. And so the three right now I like because they've outperformed the S&P on a 10-year basis are McDonald's, Standard & Poor's, and Caterpillar.
People were forecasting March was going to be the rate cut. When do you see a rate cut happening?
Good question. Clearly not March, because the Fed has kind of indicated, right, that there's still signs of inflation, and the economy is still not weakening to the levels where I think a rate cut is necessary. And so my guess is it's going to be in the second half of this year.
Okay, good to know. I'll look out for it.
Okay.
Thanks for joining us, Eric.
Thanks, Andy.
Thanks for watching. Check out more at qz.com.